Want to invest in world-class businesses that practically print money? Would you rather count sheep or count dollars while you fall asleep? Like the idea of collecting the safest possible dividends you could find? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. I've been a loyal dividend growth investor for more than 10 years now. It's a strategy that has treated me exceptionally well. So well, in fact, following this strategy allowed me to build a six-figure stock portfolio in only 3 years and also later retire in my early 30s. But as nearly foolproof as this strategy is, it still gets its fair share of critics, even as a lot of these critics are just flat out wrong. One major misnomer about this strategy is that dividend growth stocks don't grow. Well, that's a very weird thing to think. The growth in dividend growth investing stands for growth. In fact, many high quality dividend growth stocks out there are growing faster than the average stock and vastly outperforming the broader market. And I can think of two tech giants that are prime examples. Today, I want to tell you about two tech dividend growth stocks that continue to print money for dividend growth investors. Ready? Let's dig in. The first tech dividend growth stock that is printing money for dividend growth investors is Apple Inc., stock ticker AAPL. Apple is a multinational tech company with a market cap of $2.4 trillion. I know, no secret here. We've all heard of Apple, right? Everyone you know is using one of their products. Likely an iPhone or iPad, maybe AirPods, or maybe an Apple Watch, or, well, on and on the list goes. But that's exactly my point. Their products are everywhere. The reason Apple is such an amazing company to invest in is because its products and services are ubiquitous at this point. It's as dominant as a tech company can get. Apple may as well be renamed the US Treasury because it's basically printing money right now. Check this out. Despite its massive size, it's still growing at an incredible rate. They just reported third quarter results on July 27th. And get this, revenue grew by 36.4% year over year. They did over $80 billion in revenue in a single quarter. That's more revenue than a lot of S&P 500 companies bring in over an entire year. Earnings per share of $1.30 beat consensus expectations by a full 29 cents and grew by 100% year over year. A $2.4 trillion company growing sales and profit at this rate, it's almost unheard of. And you know what growing profit means? A growing dividend. Indeed, Apple has increased its dividend for 9 consecutive years. While the starting yield of 0.6% is small, it's those dividend raises that slowly add up year after year as the business grows and the stock rises in value. The 5-year dividend growth rate is 9.4%. And with the dividend payout ratio at only 17.2%, I suspect we're in for plenty more large dividend increases in the years to come. Keep in mind, Apple has almost $100 billion in cash. That gives further cushion to the dividend payout. Every time I bring up Apple in a video, I hear that it's overvalued. Well, those investors complaining about overvaluation are missing out. I called Apple a must-own stock for serious dividend growth investors in March when the stock was around $135 a share. A lot of viewers complained about the valuation and low yield, yet the stock is now at $145 a share. This is a stock that's up more than 450% over the last 5 years. And with the ubiquity of their products and services, their incredible growth rate, the printing of money, and their near $20 billion per quarter stock repurchase program going on, the stock is likely headed a lot higher despite the lofty price-earnings ratio of 28.4. Apple is repurchasing so much of their own stock that there's just not much left for the rest of us. So if you don't have Apple in your dividend growth stock portfolio yet, you may want to strongly consider changing that. The other tech giant that continues to print money for dividend growth investors is Microsoft Corporation, stock ticker MSFT. Microsoft is a global technology company with a market cap of $2.2 trillion. A trillion here, a trillion there, soon enough you're working with big money. Seriously though, the big size might lull you into a false sense of complacency, thinking they can't grow anymore. But you'd be wrong, very wrong. From Windows to Xbox to Office to LinkedIn to Azure, Windows is firing on all cylinders. Actually, they need an extra cylinder because Microsoft is operating at a level that puts them in extremely rare company. This is no sleeping giant. Their growth is off the charts. How off the charts? Well, they reported fiscal year 2021 Q4 results on July 27th. Revenue increased by 21.5% year over year. They're now producing more than $45 billion in revenue in a single quarter. Just massive scale here. Earnings per share came in at $2.17, which shows 49% year over year growth. If every company in my portfolio was growing at a 49% year over year clip, I'd be an extremely happy investor. Azure Cloud was a standout, showing 51% year over year revenue growth. There's no slowdown here. No slowdown in the business, which means no slowdown in the dividend. Microsoft has increased its dividend for 19 consecutive years, and they're really just getting warmed up. The stock's yield at 0.8% is, again, low. You're not going to get a 6% yield when a company is growing like this. It just doesn't work like that. But the flip side is the growth. The 10-year dividend growth rate is 13.6%. And with a payout ratio of just 30.5%, the dividend is easily covered. Plus, there's the fact that Microsoft is one of only 2 companies with a AAA credit rating from Standard & Poor's, a higher credit rating than the US government, which literally does print money. This dividend is only going in one direction, up. You know what else is going up? The stock. Microsoft stock has shot up more than 400% over the last 5 years. And of course it has with this kind of growth. I highlighted Microsoft as an undervalued dividend growth stock idea back in April when the stock was around $250 a share. Again, viewers left comments left and right grumbling about valuation, yet here we are with the stock bumping up against $290 a share. And you already know which direction this thing is headed in. Just look at a 5-year or 10-year chart. If you haven't already jumped on this money train, I would urge you to seriously reconsider that. Choo-choo, all aboard. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about these 2 tech dividend growth stocks printing money for dividend growth investors. Please make sure to subscribe to the channel and ring that notification bell so that you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.